welcome back to this week's market update. Today is Monday, August 19th, 2024, and we had a very full week of a lot of economic data, inflationary data, and much more. So we will jump right in. Stocks picked up more ground last week as inflation data came in soft and retail sales data came in strong, putting aside market concerns that a U.S. recession is imminent. As of close on Friday, August 16th, the Nasdaq Composite ended the week 5.29% higher, the S&P 500 up 3.9% higher, which was actually the highest weekly gain so far in 2024. The Dow Jones Industrial Average up almost 3%, and even the Barclays Aggregate Bond Index up 0.5% on the week. Heading into this week's economic news, we had the July CPI come out last week, with headline CPI coming in a little bit below expectations at 2.9% year over year, so you can see that right there. And then core CPI coming in at 3.2% year over year. So both moving in the right direction. You can see from this peak in 2022, we have made significant progress in CPI, both core and headline CPI there, and then on a monthly basis, they were both up 0.2%. So pretty subtle on that front as well. Really, right now, the question is not is inflation improving, but it is can we get inflation to hit 2% without sending the labor market into turmoil. So we'll continue to look at the categories of the CPI in the next slide here. Breaking down the CPI a little bit further, you can see the headline CPI at 2.9%. We had things like groceries up only 1.1% as a whole compared to a year ago. Energy is up just 1.1% there. That is driven by a drop in gasoline prices compared to a year ago, while things like electricity are up almost 5% from a year ago. So interesting there. And then other things, we saw used vehicles down 10.9% there, even new vehicles down 1% from a year ago. Other categories, we saw shelter up 5.1%. This continues to be a really sticky element of the CPI because it makes up such a large portion of the calculation and also just of consumers' budgets every month. Things like medical care services up 3.3%, transportation services up 8.8%. So we could spend a lot of time looking at the CPI and what was making it up, but here are just some of the main categories driving the lower than expected overall CPI, while some categories like shelter remain quite high in inflation. Before the softer than expected CPI report last week, investors received an early signal through the PPI, the Producer Price Index, which is often reflective of inflationary pressures that are likely to come as producers face higher costs and eventually a few months later, maybe a year later, do have to pass those higher costs down to consumers. So it's kind of a leading indicator of consumer inflation in some ways. In July, we saw annual producer inflation drop to 2.2%, which is lower than the last 3 months. So good news on that. However, the PPI does tend to be a bit more volatile than the CPI. And then you can see on the core number that also came to 3.3%, which is about where it has been in the 3 months prior. On a monthly basis, we saw overall producer inflation up just 0.1%, while it was up 0.3% on that core number there. And this month, it was largely driven by higher cost of goods, up 0.6% in the month of July compared to services, which were actually down 0.2% in total cost in the month of July. Another data point that got a lot of attention last week and also drove quite a bit of last week's rally, July retail sales. So retail sales came in at 1% of a monthly gain from June to July, and it was up 2.7% compared to July of 2023. Most categories saw an increase in spending last month, with the auto-related sales leading the way, up 3.6% in the month of July. So that's quite a bit of a jump. Maybe consumers are seeing prices drop from a year ago, and so they want to swoop up these deals in used and new cars before they go away. We also saw that retail sales, even excluding this really strong category of auto, was still up 0.4% in the month. So really strong retail sales numbers shows that the consumer is still spending. Although we did get that unexpected uptick in the July unemployment rate, consumers still spent quite a bit in the month. So overall, this is quite a positive story for the Fed, supports the case for a soft landing ahead as opposed to a recession. As inflation data continues to move towards the Fed's 2% target, while the US economy continues to grow at a slow but steady pace, investors are now wondering when is the rate cut. So, initially, the inflationary data was driving a lot of the rate cut expectations. Now it's more of the economic activity. So, the labor market, GDP growth, things like retail sales, and we saw that in the last week of expectations for Federal Reserve rate cuts. Just between August 9th and August 16th, markets shifted from pricing in two rate cuts. So you can see in the light blue box here that is pricing in two rate cuts just a week ago, now to pricing in just one. And that is with a 75% chance of just one rate cut according to these probabilities for the September Fed meeting. So really interesting stuff here. Definitely will continue to shift in the coming week. We have the Jackson Hole speech that Jerome Powell will be giving later on this week, and a lot of other economic and inflationary data in the meantime. So we'll continue to watch it and keep you posted with what the market is expecting and what we expect. Last but not least, we had the University of Michigan Consumer Sentiment Index. So, as economists and investors are looking to see how the US economy is really doing, consumer sentiment is a great measure of how consumers are feeling about the economy. You can see here there was a small uptick. This is the monthly data in the dotted line. Small uptick in August index here, although we have been in a greater downtrend really since the start of 2024 here, and we are nowhere near the pre-pandemic norms of the 90 to 95 range of consumer sentiment that we've seen in prior years. In the consumer sentiment index, there was a lot of attention on elections, and we'll jump into that in the next slide. As an asset manager, we do not work in politics, but sometimes they do undoubtedly just overlap with economic data. And in the University of Michigan's most recent Consumer Sentiment Index, we saw quite a bit of interesting changes in political parties and consumers by their political parties. So this election season is set to be a key focus for markets in the upcoming months, as each party will definitely have different priorities that influence economic growth, corporate earnings, inflation, geopolitical events, and many other characteristics that we do track closely with. And in this most recent month of data, you can see that Democratic sentiment rose significantly in August. Independent sentiment also rose slightly, and then Republican sentiment fell about 5% in the month of August. So, just really important things as we come up on the election season. It will definitely have impacts for markets and just how consumers view the economy. So, we want to keep a close tab of what consumers are thinking and feeling about the economy ahead. That was it for this week's market update. We really appreciate you tuning in each week, and we look forward to providing another update to you next week. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.